Good evening, ladies and gentlemen. You're watching Startup Central right here on ET Now with me, Sumita Karir. Over the next 30 minutes, we'll be bringing you stories and interviews from the world of startups, technology and entrepreneurship. And if you're interested in all of these domains, we suggest you watch Startup Central Mondays at 7 p.m. only on ET Now. So what's on the show today? Well, we're putting the spotlight on Square Yards. That's India's newest unicorn on the block. In fact, the company has also decided to minimize its global operations. But exactly why? We'll tell you all about that. But first, let's take a look at our exclusive interview on the show today. This one is with Delhivery. All right, then, on the show, let's put the spotlight on India's largest fully integrated logistics services provider, Delhivery. Now, Delhivery has just completed 15 years of its operations in India. What started with food deliveries in Gurugram has now grown into a nationwide network handling express parcels, warehousing, freight, and supply chain solutions. Now, this journey has been fueled by the rapid growth of e-commerce, increasing digital adoption, and significant investments in technology and infrastructure. And today, with over 4 billion worth of shipments, the company today has a nationwide network covering close to 19,000 PIN codes. After 15 years of moving India forward, the question hence is, what's next on Delhivery's schedule? To talk about that and more, I'm now joined by Sahil Barua, the CEO of the company and the co-founder of the company, is now joining us to speak about this and more. Thank you very much, Sahil, for taking the time out and speaking to us here on ET Now. 15 years is a long time, a decade and a half since you started the company from local delivery business, and now you've evolved into a logistics giant. What have been the key decisions that actually enable the kind of transformation that the company has seen?
Thanks for having me, Sumita. Yeah, it's been 15 years and really time flies. I think the biggest decision that we made, which was correct right at the start, was to say, look, we're going to treat Indian logistics as a whole as sort of the addressable market for delivery. You know, our focus has always been, how do we service all of our customers' needs? And over a period of time, I think that stood the company in good stead. You know, we obviously started in e-commerce, which is where the biggest opportunity for us at the time was. But as we've grown over the years, you know, we've expanded into multiple new services, whether it's part truckload freight or full truckload freight or warehousing. And that's sort of been one of the cornerstones of Delhivery's growth, which is, you know, when a customer has a logistics need of any kind, we have the wherewithal and the ability to service it. I think the second sort of big decision that we made early in our life as a company, which really has been a long-term bet and continues to be one of sort of our core principles, is to build all of our technology and our automation in-house. You know, very early we said, look, the reality is for an Indian logistics company to be successful, it must have a product technology and data sciences base which is uniquely Indian, and we have to build automation and robotics for India, and specific to sort of the challenges that Indian companies face. So whether it's, you know, building an addressing stack or a map stack like we have, whether it's building robotics for our sortation centers, you know, those early decisions are things that over this 15-year period have really held us in good stead. But yeah, I mean, the story of a company over 15 years is really a series of very small decisions made over a very long period of time. So it's very hard to sort of pull only a few out.
Absolutely, and it has yielded returns, Sahil. But if I were to ask you to sort of, you know, crystal ball gaze into the future, and what will be some of the decisions that you will probably take, or what is going to be the next leg of growth as far as Delhivery is concerned, where do you see sort of movement happening, and how do you plan to grow from where you are today?
So three, four ways that we look at it. One, obviously, is continuing to penetrate industries that we've already sort of entered over the last 5, 6, 7 years or so, right? Which is really more of the same. Expand the network, continue to build capacities. You know, high quality logistics capacity in India continues to be something which is relatively sort of less than the economy will need if we are to become a $5 trillion economy. So Delhivery will continue to invest in building capacity. We will continue to invest in sort of building out, you know, robotics capabilities, business development capabilities in different cities, expanding our reach, bringing in more truck forms. That's sort of what we've always done, and we'll continue to do that. That delivers sort of one leg of growth. The second is adding new services, you know, compared to what we do today. So one example is, you know, we launched Delhivery cross-border, where we have the ability to do not just parcel, but also freight from India to the rest of the world and from the rest of the world into India. So that's a new service for our customers. The other is Delhivery local, where, you know, we were relatively underpenetrated in city logistics. And now we're sort of expanding that service for all of our 50, 60,000 customers that we have across the country. And we obviously continue to offer technology services, another growth lever. One of them is warehouse management solutions, transportation management solutions. We've recently launched a map stack. So those are also going to be areas of growth. And the last bit will be sort of new verticals that we've historically not serviced. In India, for example, agri-logistics is a space that we've always sort of wanted to have a certain play in. So very large buyer of logistics services. We haven't done much in that sector so far. So that's another sort of new vertical that we expect we'll enter over the next couple of years.
Right. So, Sahil, you're talking about some very, very interesting points here. You've touched upon, your cross-border trade and, of course, the kind of services that you provide in that front. But you also started Delhivery International for MSME exports. And that really comprises of the kind of decisions that you've taken in the past couple of years. So when we talk specifically about Delhivery International for MSME exports, what are the kind of orders that you're clocking on that front? And secondly, as part of this very question, when you talk about international arena and giving a boost to exports and, of course, enabling MSMEs, what are the kind of gains that you're seeing from FTAs, or do you expect to see from FTAs that India is sort of inking with multiple partners across the world?
Yeah, so I think in some senses it was fortuitous timing. When we announced Delhivery International in December, and then, for example, the European FTAs have happened after that. Obviously, a reduction of duties is good for MSMEs shipping, for instance, to Europe. The US is still sort of relatively volatile, though we see quite a bit of volume going there. Our anticipation is that as the market for Indian products grows, providing this service to the customers that we have is opening up these new markets to them. Now, we do two parts of this. One is e-commerce, where they're sort of shipping directly to consumers or they're shipping to retailers in these economies. We have the ability to enable sort of this seamless service for somebody who's doing domestic e-commerce with us or domestic shipping with us to now also be able to service orders from a consumer in the US or from a consumer in the UK or in continental Europe or Australia or elsewhere. The other, obviously, is in countries like the Gulf countries or Southeast Asia, you also have an Indian diaspora who wants to buy products from India. So again, our cross-border business opens that up for them.
Right, absolutely, Sahil. So when we talk about operating internationally, will you be considering geographic expansion into the kind of geographies that you are currently working from some of the other countries?
I don't think we'll ever put boots on the ground, Samita, in any of these countries. So we're not going to go and launch transportation operations in other countries because we believe that local players will have advantages that a delivery cannot actually match. But will we build over a period of time a network of fulfillment centers which enable us to have a base in those countries? I think the answer to that is probably going to be yes, as our shipping volumes go up. So operating in free trade zones, being able to warehouse in some of those countries and then link up with transportation networks who are leaders in those countries, that's sort of the strategy that I think Delhivery will take.
Right, Sahil. So since we're talking about India's logistics landscape, well, that has changed dramatically. And changing the logistics landscape dramatically is AI. How are efficiencies being driven at Delhivery due to AI, especially when it comes to your operations? And the kind of efficiencies that you're driving from AI, is that also reflected in your financials?
To some extent. So I think where our use of AI is particularly large, I'll break this up. One is in internal operations, and the second is in customer and client-facing operations. On the client-facing side, what we've been able to do is to make it far easier for clients, for example, to manage a lot of the administrative processes that come with shipping. So today, if you're a customer, you can onboard yourself and start shipping with Delhivery practically in minutes. You can manage your tracking, you can manage delivery issues, for example, you can manage customer service almost seamlessly and very often without any manual intervention, either from a customer standpoint or from the logistics company. The other, obviously, is management of things like claims, returns, delays. All of this now is sort of becoming relatively automated. From an internal operation standpoint, the biggest users of AI for us, one is in terms, obviously, of how we route packages. But I'll leave that out because we've been doing that for a pretty long time. The other, obviously, is we're using systems to determine in-facility movement. So, if you come to our facilities, we're starting to replace human operators moving goods within the facilities with autonomous vehicles. Now, that is one area where we're using AI outside of just control tower operations and so on. And the other piece is on geolocation and on maps, for instance. So those are starting to show up in terms of operating efficiency. So if you look at our margins, they've been expanding now quarter on quarter for a period of time. So that's sort of how AI is impacting financials overall.
Right. Sahil, let me also ask you about your financials since we're talking about financials. You closed 10,500 crores in revenues in FY26, which is a growth of 18% year on year. Now, which segments remain the biggest contributors to that, and where did gains essentially come from?
So the biggest gains, obviously, from a growth standpoint, were in our parcel and our PTL business, both of which actually grew pretty strongly last year. Parcel growth obviously was aided by the fact that we acquired Ecom Express, and then of course there was organic growth and share gain overall. And then the PTL business, we've been the fastest growing part truckload network in India for a couple of years now. We're now I think the second largest organized player in this space. As we continue to sort of grow capacities, as we continue to grow our business development outside of the major 15, 20 cities, we continue to see large growth on the part truckload side. Going forward, obviously, these businesses will continue to grow, but we also anticipate now future growth coming from our supply chain services business. We've gone through a period of sort of reorganizing performance in that business. That phase is now behind us, and we now anticipate that this business will grow pretty strongly as well.
Right. Right. And Sahil, revenues of the company, if you talk about that, well, 30% in Q4 FY26, and your profits actually remain flat. Now, given that the logistics business that we're talking about, it's a low margin business, how will you ensure profitability, and that too in a market wherein you have well-funded competitors?
Operating leverage in our business, that's played out quarter on quarter for now 15 quarters or so. One of the reasons why our profits looked flat in Q4 versus before is we continue to invest in new capabilities that we're building. If you look at the core businesses, the profitability of both the express parcel and the part truckload business actually were at historic highs in Q4. But we're building out Delivery Local, which is a new business. We've been building out Rapid Commerce. We've been building out the cross-border business. So effectively, what's happening is the company is reinvesting some of the profits that we're generating into building newer capabilities and newer growth engines for the future. But otherwise, our core businesses continue to expand profitability.
Okay, and you've earlier stated, Sahil, that logistics is no longer a business where companies can indefinitely burn capital. But you do have players like Amazon, for instance. They've made an announcement just this morning. Is there a concern about potential challenges that could be posed to your market share at the moment and to your leadership in this segment?
Not really. Fundamentally, structurally, it's very difficult for first-party logistics companies to service third-party logistics easily. One is very simple. The relative size of customers to the sort of anchor customer in first-party logistics is too large. So when you have a capacity crunch, it's always very difficult for a first-party network to allocate capacity to third-party players. And automatically, what that means is service reliability takes a hit. The second, as we've pointed out over a very long period of time now, and it's sort of been borne out by the financials as well, is that it is cheaper to use a third-party partner. And I don't speak just for delivery alone. This is true for all third-party logistics companies. It is cheaper to use third-party logistics. First-party logistics is less efficient for structural reasons, one of which is load management. They have to build capacities which are sort of relatively closer to peak, and their peaks and troughs are large. The second, of course, is that they largely do only e-commerce. One of our big advantages comes from being an integrated network which doesn't just do e-commerce. Because we don't just do e-commerce, our margin structures are significantly better. So as long as delivery continues to be reliable, as long as we continue to be operationally sort of ahead of the curve, as long as we invest in technology and automation, I don't think our market position is at risk. Of course, if you are a player who has nothing to offer but price, then you should be worried.
Absolutely. And Sahil, you've also sort of acquired the Ecom Express as well. Will you be looking at further expansions to sort of consolidate your position in the market? And second question related to the Ecom Express acquisition, by when do you think investors should expect this acquisition to become earnings accretive?
Well, it's already been earnings accretive if you look at it. We've been declaring this for the last 3 quarters. In fact, the interesting thing is that we anticipated initially that the acquisition cost would turn out to be close to about 300 crores. And that's what we'd messaged when we made the acquisition. Interestingly, we were able to complete the integration sooner than planned and at a significantly lower cost. So that acquisition has already been earnings accretive, and it'll show up fully in our in this financial year. And in terms of new acquisitions, I think, look, from our standpoint, at the right price, of course, we will continue to be acquisitive. We do believe that the industry will consolidate over the next several years. It's not just a 1-year thing. I think Indian logistics will consolidate for the next decade. And delivery is the natural consolidator in this space. And so we will continue to look out for opportunities, wherever we find them.
But it's also an industry, Sahil, which can be disrupted by newer entrants as well. But let me ask you a bunch of other questions as well. And this one is related to the volatile conditions that we've seen on account of the West Asia conflict. How much have your costs as a company, they've gone up, and how much have you passed those costs on to the consumer? And as of now, even though we're still waiting for some sort of stability to come in as far as the conflict is concerned, but what's your reading on the situation as of now? Do you remain cautious or optimistic?
We're always optimistic. Entrepreneurs by nature are always optimistic. But no, on a more serious note, look, I think we were worried when the conflict began, but fortunately, fuel disruptions didn't happen. We were able to keep the network running with absolutely no disruptions across the country. I think this is an essential service also, so that helps. Fuel costs, of course, have gone up in this period of time. The good thing is that all logistics companies have contracts with customers which are indexed to fuel price. And so we are able to pass on fuel price increases to customers, and customers understand, pay for it. It's a direct input cost. So in that sense, there hasn't been, any sort of major degradation to either our demand or our margins over a period of time. The other thing is that we have a structural advantage. Fuel as a percentage of our costs is lower than it is for most other players. This is both because of the network we run and the kind of assets that we use. So as a consequence of that, when fuel prices inflate, the impact on delivery is a little lower.
Right, right. So, of course, you have passed on costs to consumer on account of that conflict, but you do hope that customers understand that. But on that note, let me also ask you about your outlook for the festive season. Do you anticipate that GST rate rationalization benefits that accrued to many companies like yourselves, will they be able to sustain, will companies be able to sustain those benefits this year, or are you expecting to see a dip in consumer spending?
See, so far what we're seeing in this quarter is that volumes have held up. And this tends to be actually a low quarter in the financial year. April, May, June is never a particularly strong quarter, but volumes have been robust in this quarter as well. Now, if this is an indication for the rest of the year, then our view is that we should be okay getting into the festive season. Of course, one hopes that there's no escalation in the conflict in Iran and so on. But otherwise, I think we're quite optimistic.
Absolutely. Sahil, one final question before we let you go. Your growth outlook for the company this quarter and for this overall financial year?
I think we've signaled this in the past, right? We think e-commerce grows at about 15 to 20% a year. Delivery's worst case is we grow at the same pace as market. So that is 60% of our business growing at, let's call it 15 to 20% a year. Our part truck business has been growing steadily at 20, 25% a year, that sort of range. We don't anticipate any change to that. And then our supply chain services business, which last year, as we were correcting, certain parts of the business, had degrown, but we anticipate growth in that business as well. So net, I don't see any reason for delivery to not sort of meet our 15 to 18 to 20% kind of growth numbers that we've been talking about.
All right. So positive growth trajectory is what you're anticipating for the company going forward. There could have been some hiccups in the past, but of course, you remain optimistic on that note. Thank you very much, Sahil, for speaking to us here on ET Now. And we do hope to do this in person the next time we interact with you.
Absolutely. Thanks for having me.
On that note, it's time.